This is the Asia Trade. I'm Shery in Bloomberg's Asia headquarters in Hong Kong.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Australia's central bank is widely expected to cut rates today for the first time in 4 years, but trade turmoil and resilient consumer spending could still produce a surprise. BHP'S first half profit tumbling 23% on lower Chinese demand. The world's biggest listed miner also cut its dividend payout to the lowest since 2017. Also ahead, China's president meets with tech leaders, including Alibaba's Jack Ma, signalling that the sector is back in favour. And a Delta Airlines flight from Minneapolis flips whilst landing in freezing conditions in Toronto, injuring at least 15 people.
Take a look at how we're opening at that staggered open in Australia. Of course, very slow, but we are expecting to see perhaps some reaction to that BHP profit data slumping given Chinese demand. We are seeing the Aussie dollar at the highest level in 2 months against the greenback. Same for the Kiwi dollar as well. We are getting the RBA rate decision today, the RBNZ rate decision tomorrow. We're watching the offshore yuan at around those 3-week highs. Of course, President Xi Jinping's sort of re-embrace of the tech sector, really improving sentiment across markets. The Japanese yen holding at that 151 level against the US dollar. We saw strength overnight. Of course, we had the more positive than expected fourth quarter GDP numbers out of Japan in the previous session. We have seen those expectations of BOJ tightening continuing to rise. Now, flip the board and you can see perhaps US futures also the fact that we are closed for the U.S. markets on President's Day, but we saw that European rally with stock markets at near record highs given those defense names really climbing on expectations of more security spending in the region. We're watching oil prices as well. We might get OPEC delaying perhaps those supply reductions that we were expecting to begin in April. That would be the 4th delay already. They're watching the broader global market very closely, Heidi.
Yeah, and of course, top of mind today is the RBA decision. Australia's central bank widely expected to cut today, finally joining in on that global easing cycle. But there is a handful of economists that still see reasons for policymakers here to hold. For more, let's bring our economy reporter, Swati Pandey, who, and it is a balance if you take a look at the data. So could we perhaps see, hawkish commentary even with a cut?
Yes, that is a consensus, a hawkish cut. The biggest reason for the RBA to cut today will be inflation. Inflation has come off at faster than expected pace. But then there are other factors that are supporting case for hold, which is still strong consumer spending, still strong labor market, depreciating currency, Trump tariff situation in the U.S. There's a lot of uncertainty. We have an election year as well, so there's going to be an election in May, and that just adds to the uncertainty as well. And so a lot of people are saying if the RBA does cut today, they're going to sound really cautious, and they are not going to provide much forward guidance either.
We've seen in the US the signs of quite an uneven easing cycle, right? Could it be quite a shallow one here too?
Yes, so markets are pricing just 3 cuts for the whole year. So at the end of 2025, markets expect the RBA will end around 3.6%, and that is the Bloomberg Economist Survey median as well. And part of the reason is that uncertainty. Part of the reason is that the last mile of inflation is proving to be difficult to cool, and that is driven by stronger government spending. And we've had tax cuts here. We've had some energy rebates by the government, and that has allowed consumers to probably feel a little bit more confident about going out and spending there, and that's adding to demand. So that's playing in the opposite direction to the RBA.
At the same time, so much uncertainty over potentially tariffs coming from the Trump administration.
That is right. So far, it does look like Australia is not getting the brunt of it. It does look like Australia will be one of those countries that probably is the least affected. We are part of the country that get the broader tariff as well. But Australia is working with US to try and see if we could get some exemption. The last time that Trump was in office, Australia did win an exemption, and expectation is that we will again this time. But also a point to be noted is that Australia does not import or export a lot to the US, so it's not such a big export market for us. So even if there is tariff, it's not going to affect us as much. The impact will be via China slowdown, because China is our biggest trading partner.
Our Bloomberg economy reporter Swati Pandey, they are looking ahead to that RBA rate decision today. And of course, when it comes to tariffs, China could be a big target for the Trump administration. And we have seen Beijing trying to support the economy there. Chinese President Xi Jinping presiding over a high-powered gathering featuring many of the country's biggest names in business. Among them was Alibaba founder Jack Ma, whose presence sends a strong signal that the long marginalized tech sector is back in the good books. Let's bring in our China correspondent, Min Lo, in Hong Kong. And Min, of course, Jack Ma was one of those very high-profile casualties of that crackdown on the private sector. But who exactly was at that meeting, and what did President Xi say?
Yeah, so all the big wigs of the private sector were there. So DeepSeek's Liang Wenfeng, Huawei's Wen Zhengfei, Xiaomi's Lei Jun, the EV players were there, CATL, BYD, Meituan as well. So many of these big players are present. And aside from presidency, you have Li Qiang, the premier, a couple of standing committee members of the CPC Central Committee was there. So a very high-profile symposium that presidency very rarely holds. The last time he held such a symposium was back in 2018. Where there had been some concerns over the state of the private sector as well. So what did he say this time? And let me read you a quote. He said that this is a prime time for private enterprises and entrepreneurs to give full play to their capabilities. The private sector enjoys broad prospects and a great potential on the new journey in a new era. So this is a sense that the government is perhaps shifting towards a more enabling stance and more supportive towards the private sector after years of crackdown. As you said earlier, Jack Ma, that very prominent face who suffered from that crackdown, now back in under the public spotlight again, suggesting that maybe this is the end of that era, and the government recognizes that we want these private enterprises to continue innovating, continue promoting consumption, because guess what? The private sector, they contribute to about 60% of economic output, more than half of tax revenue, according to official estimates.
Yeah, that very much expected the IPO of Ant really being scuttled by all of this crackdown coming from the government, right? So how significant is it that we're finally seeing this sort of show of force behind these tech leaders?
Yeah, I think it's interesting. Jack Ma in particular is of significance because he was that poster child, if you will, of that crackdown at that time, and now he is set in the front row of the business executives at the symposium. He got a handshake with President Xi, so a very strong signal here that his company perhaps is now back in safe territory when it comes to its relations with the government. And I think what's interesting is also the speculation around who was not there, because Robin Lee from Baidu was not mentioned in the guest list from what we can tell in the CCTV footage. He's not there. Reuters reporting that he wasn't. ByteDance as well. So it's interesting because if President Xi gives you an invite, there's no way you're going to say no. So is it that Baidu was not invited? And does it mean that they're falling out of favor with the authorities, or is it just the waning influence of a company in a space that is increasingly competitive with many new players that are making a lot of breakthroughs in that arena? So a lot of questions there about who is not there as well. That's significant.
And it seems also to be sort of this shift with Beijing being, if we are engaged in this growth of the private sector, then that might be okay. That sort of signal perhaps from Xiaohongshu, the owner of the Red Note app, that perhaps if you have a state-owned entity working with you, that perhaps this is okay?
So this is what we're hearing from sources, because Xiaohongshu has been eyeing an IPO, hoping to raise about $20 billion. But that process of getting approval appears to be getting into a bit of a snag. And it looks like regulators have informally indicated to Xiaohongshu that if they have a state-owned investor, that could maybe smooth the process of getting approval for future listings. So it's interesting here, not clear yet whether Xiao Hongshu will act on that because, of course, any tech companies with links to the Chinese government now is under a lot of scrutiny from the likes of the US, even private companies coming under fire. So it's a strategic decision that Xiao Hongshu has to take, given that it's risen in prominence, especially after the TikTok saga where all these so-called TikTok refugees flock to its app. So it's an interesting decision they have to weigh here. And again, it shows that even as presidency held that symposium and signaled this sort of more embracing stance toward private enterprises, they're not fully giving free rein to the enterprises. You see the government's hand at play, and these companies still, prosper at the will of the state in some ways.
Bloomberg's China correspondent Min Min Lo there. Well, Ukraine is calling on the EU to quickly nominate an envoy for potential peace negotiations with the US and Russia. That says the US Secretary of State. And Russian Foreign Minister prepared to meet in Riyadh with European and Ukrainian officials not involved. Let's bring in Bloomberg News editor Michael Heath. And, the idea is we should act and not reflect, according to Zelenskyy's office representative here.
Yeah, and look, in fairness to Europe, it does seem like the shock therapy is working on it. There is an effect on it. Leaders of some of the main countries, particularly the ones who are fairly strong on defence, met yesterday and are discussing potentially putting additional money into to bolster their defences, and also this issue that Ukraine has rightly pointed out that Europe needs one individual to sort of speak on its behalf, and it sort of needs to be someone at leadership level. So perhaps Poland's Donald Tusk or someone else that can sit at the table with Donald Trump and Vladimir Putin on an equal status and sort of advocate for Europe. But in fairness to Europe, it does seem like it's after years and years of sort of dragging its feet and ignoring this, that it is suddenly spurred into action. So it's going to be very interesting to see who they come up with. And also, obviously, these talks in Riyadh that neither Europe nor Ukraine were invited to, just what comes out of that. Russia seems to be putting a lot of store on it. Ukraine has said that basically it's irrelevant until Ukraine's involved.
And part of that spring to action is looking at different ways to fund defence packages and further support for Ukraine as well. Yeah,
and so this whole issue, which is sort of has been quite sensitive about Eurobonds, joint financing, even countries like Denmark that have historically been very fiscally responsible and don't want to sort of get involved in these very expensive big European projects are now saying that this is something that has to happen. And Europe sort of needs to be able to look after itself. And it's one of these ironies. Always when President Vladimir Putin makes these aggressive moves, he accuses NATO or Europe of something that ends up coming to pass. And so now you're suddenly going to find that Europe's probably a lot more muscular militarily and a lot more threatening to Russia than it previously was, which is sort of one of the reasons he said that he had to go into Ukraine to prevent it becoming part of NATO and all these sorts of things. So it's always ironic how that turns out. But Europe definitely does look like it's prepared to do something. Germany's foreign minister has said there's a big package coming. Even Christine Lagarde from the European Central Bank has said that this is something that Europe needs to do. So it's a lot of money, though. I mean, Bloomberg Economics has estimated that to help to support Ukraine and also look after its own security, it could cost $3 trillion over 10 years. So we're talking big dollars there, big euros.
Yeah, and we have seen the market reaction to that already, right? I mean, we saw European defense stocks gaining ground and European bonds just like being pressured on the expectation that we might see more common debt.
Yeah, well, that's exactly right, Shery. And I mean, obviously, Europe is, it's a fairly indebted organisation in general. But those defence companies are particularly interesting because some of the leaders were asked about buying more equipment from the US, sort of as a sop to the Trump administration, and they were sort of against that. They were like, well, if we're going to get our own industries going, if we are going to increase our, defence, we may as well start at home and get that happening rather than just buying in from abroad. And Europe is trying to gear up its production of various weapons. And the reality is, because they're allies, there's always US components in various European armaments and that sort of thing. So, it's going to be interesting to watch and just how the markets respond to a lot more debt coming in. It's a question to observe. But these are the big countries involved. We're talking Germany, France, we're talking Britain, Denmark, Poland, Spain, all these sort of places. So you suspect that the market will absorb it, but this is something that does seem like it's going to happen.
Bloomberg News editor Michael Heath there with the latest. And another story that we're tracking closely, at least 15 people have been injured after a Delta Airlines plane flipped upside down on landing in Toronto. The flight from Minneapolis landed at Pearson International Airport in windy and freezing conditions. 3 of the injuries are described as critical. We'll have a live update out of Toronto later this hour. More ahead here on the Asia Trade. This is Bloomberg. All right, take a look at how we're shaping up when it comes to just the first 15 minutes or so of trading here in Australia. On RBA decision day, this is still a market that's coming off those record highs of last week. So we're a little bit of sideways trading being seen at the moment. We have a bit of downside there when it comes to the ASX 200, as well as not much of a move when it comes to bond yields at the moment either. The Aussie dollar is just sort of hovering at 63.52. Some of that recent Aussie strength has really come from what we've seen from the US dollar moves, but also part of that is still seeing that we could see strength, particularly against the likes of the euro, if we get that hawkish cut from the RBA today. So our next guest also doesn't expect a particularly dovish tone from the central bank. Mahjabeen Zaman is a head of FX research at ANZ. So does that suggest that there is a pathway to more strength for the Aussie dollar?
Look, I think context is everything, right? And just a starting point of this easing cycle today, likely, where we see the economy in a much better position than it was in previous easing cycles. I mean, previous easing cycles, GFC 2001, 2011, where the Aussie was already falling because of global growth slowdown, was a different dynamic. And as a result, this time around, we think there will be less room for further downside on the Aussie just because the Australian domestic story still remains pretty resilient. And at the same time, of course, we are looking at a pretty shallow easing cycle as well.
When you take a look at what we could see outperformance for the Aussie dollar, how does it shape up against the euro, particularly when it comes to the relative tariff risk scenarios?
Look, I think Australia at this stage, I mean, the tariff story is still evolving. But even if when we look at, upcoming steel and aluminium tariffs, for example, we don't think Australia will likely be significantly impacted just because the quantum of exports are much smaller. Europe, again, is a different story. And I think Europe has bigger challenges outside the tariff risks. The ECB is poised to cut. We're expecting a total of 150 basis points of easing this year from the ECB. And that should likely weigh on the euro. I mean, we're expecting Euro-US to likely see parity before moving upwards over the next 2 quarters.
Mahjabeen, is that the broader narrative why we're seeing investors using the European currencies in order to bet on the Japanese yen? I mean, the expectation that the euro will fall, but the BOJ will tighten and perhaps the Japanese yen strengthening from here.
100%, and I think that story does make sense. I think there is rate divergence story playing out there. Growth differentials are also dominating. I mean, we had the Japanese GDP just this week, and that beat. And I think that consumer story in Japan is starting to pick up. They're more resilient. And again, we're going to see how the wages numbers play out over the next, Shunton negotiations. And if those wage increases continue to stay into play, then we expect the BOJ to continue raising to 1% this year.
All in all, though, given the tariff uncertainties, we have seen this huge rally for gold prices. Is that something that can be sustained?
Yeah, I think for now, it looks like we are pretty optimistic on the gold prices in the near term. We're forecasting 3,050 in the first half, and then for second half, a little bit of stabilization to 2,900. Again, still pretty much on the higher side. I think there are 2 or 3 things driving that. I guess the first is, fears of U.S. imposing blanket tariffs has led to the movement of gold from other trading hubs to the U.S. And so there's a little bit of a spread between futures and spot that's driving gold prices higher. Of course, we've had central bank support throughout the last 2 to 3 years. We have seen, central bank demand, double up since in the last decade or so. And then, of course, there's always investment flows and investment demand as well. It is, after all, gold tends to be a safe haven hedge. That's playing out. And of course, more recently, we saw US CPI come out higher than expected. And if that continues, again, gold also plays the role of an inflation hedge as well.
Yeah, going back to central banks and the narrative here, we of course have the RBA and Z as well. What are your expectations for the Kiwi dollar, especially when you put it against the Aussie?
Look, I think that's a great question. I think RB and Z, the growth dynamics are a little bit more softer than Australia on a relative basis. So we continue to expect the Aussie to outperform. Further to that, when we look at interest rate differentials, look, I think there's a huge or much larger magnitude of easing priced in for RB and Z. I mean, they're going to go 50 basis points this week, and markets pricing in much more aggressive rate cuts ahead as compared to the Aussie. And so we think that between the two, we likely see better performance broadly Australia on relative growth and rate differentials.
As you say, any sort of sustained upside for the Aussie dollar depends on really further downside for the US dollar. What do you see in terms of the next catalysts for the greenback, or is it sort of still the same, theme of tariffs?
It's been pretty, as for all of us, it's pretty difficult to time the tariffs and when the peak, implementation is going to play out for the tariffs. Right now, with the data that we have or the information we have, we're looking at sometime in March towards early Q2 when we start seeing more actual implementation of all the tariffs that Trump has been speaking about. And we expect that to lend some support to the US dollar, at least in Q1 and Q2. So we see near-term downside in dollar crosses. And then Q3 and Q4, some stabilization there in the dollar. Still, dollar is going to remain structurally strong, overvalued, but maybe marginally lower from the peak, which is yet to come.
Mahjabeen, Zaman, the head of FX research at ANZ, as we continue to watch Australian assets closely today. Subscribers can turn to the Bloomberg for more on the RBA decision later. You can go to TLIV Go to get that commentary and analysis from our expert editor team. One of the companies that we're watching today, one of the stocks, I should say, is BHP in the session. We saw that first half profit falling 23%, largely on that China demand story, which dampened demand for iron ore. We're seeing a bit of downside there when it comes to BHP, the cutting of the interim dividend to an 8-year low as well. We also saw some sort of natural disaster implications. The mines in WA hit by Tropical Cyclone Zelia. It has, though, maintained forecasts when it comes to output, but no longer expects output to be in the upper half of that range. But on the upside, they did see quite a bit of upside for growth in the copper business as well, with at least $10 billion spent to maintain and grow production across the Chilean portfolio. One of those that we're watching, but of course we'll get some more analysis on those BHP numbers, the capital allocation outlook as well, with the CEO Mike Henry. He'll be joining us at 10 a.m. Hong Kong time. That's 1 p.m. if you're watching here in Sydney. More ahead on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade. Hamas says it's willing to stop governing Gaza after the war ends. A Hamas spokesperson says it's not necessary for the group to be part of the political arrangements in the next chapter, as long as that serves the interests of the people. India's finance minister says she will continue to cut import taxes and reform tariffs to make India more investor-friendly. Nirmala Sitharaman was speaking at an event in Mumbai. Economists say India's $41 billion trade surplus with the U.S. makes it among the most exposed to Trump's tariff threats. We have more ahead. This is Bloomberg. We continue to see improving sentiment towards Chinese equities, especially with President Xi Jinping signaling some endorsement of the private sector, especially tech. We have seen the HSCEI index rising to a 3-year high before giving up some of those gains in the previous session, but still we've seen it roar in the past month. And with that, the fortunes of some of these tech billionaires, Pony Ma, co-founder of Tencent, briefly becoming China's richest person with almost a $57 billion fortune. Jack Ma also adding more than $5.5 billion to his wealth. Our next guest says even though we've seen a big rally in Chinese tech stocks, it will take more time for it to replace the property sector as a growth engine for the economy. Joining us in the Hong Kong studios, Hao Hong, partner and chief economist at Grow Investment Group. Oh my goodness, so good to see you back in person. It's been a few years and so much volatility and ups and downs for the Chinese market since then. Do you think this is a sustainable rally?
It's a good rebound. So I think before it really evolved into a multi-year sort of a rising trend, a lot needs to be done. And for now, I think many of us are still seeing fundamental problem with the Chinese economy. So as such, the earnings growth hasn't been sustainable for some time. For the past 10 years, earnings per share in the Chinese market is more or less the same. So basically, the change in the stock price level has been the result of changing in valuation multiples. So if you really want a sustainable bull market for the long term, you really want a sustainable growth model going forward.
There's a lot of optimism about these cheaper AI models and perhaps that China could lead the way when it comes to the new tech revolution. Could that sustain those expectations?
I think for now, people are really enthusiastic by the prospect of it. I think DeepSeek did a really good job to break the technology hegemony and the embargo from the U.S. Now, having said that, though, I think it's still very difficult to see how to monetize from this app. And also, Chinese are renowned for not willing to pay for software. So I think if you look at back in the 90s, right, so when Windows was first introduced to China, so basically 99% of the copies used in the market is actually pirated copies, right, all the way until like 10, 15 years later. So, it's a difficult market to monetize. I think it's still very early stage. It's a huge breakthrough, but then at the same time, for now, I don't see a good way to monetize it.
Does the Xi Jinping meeting, the idea of Beijing's endorsement for the sector now, does that still have the same power that it would have used to as some sort of government put?
I think back in 2018, November 2018, there was a similar meeting with the private entrepreneurs in Beijing. And back then, it was at the depths of the trade war back then. And the Chinese market didn't bottom until like 2-3 months later in January 2019. So that is telling you a lot about, the signals from these meetings can be fleeting. And also yesterday, if you look at the market reaction, firstly, the market was rising strongly in Hong Kong, but then regurgitated a lot of the gains towards the end. And also yesterday's, the best performing sector is actually the SOE sectors. The private sectors, for some reason, is lagging substantially yesterday.
And I'm guessing you think that none of this exuberance or that we've seen so far is enough to counterbalance against the broader economic malaise, the property overhang. What more can the government do from a policy perspective to really change the mindset there?
Yeah, I think so far this technical rebound has been the result of the sentiment change, right? So because the DeepSeek moment really woke up the Chinese investment community and see, wow, what is possible, right, going forward. And also the Chinese tech sector valuation has been depressed for a long time. And some of the foreign investors have been buying, for a sort of a trading opportunity. And I think that sort of set off the rally in the past months or so. I think right now, we're running into a very strong resistance level, right? So these are key technical levels, and many of our technical indicators are actually running into very strong resistance. So for the market to go substantially higher from here, a lot needs to be done. A lot of policies needs to be set, in March in the coming twin sessions.
Always with the voice of caution there, but I really find it interesting the timing that you have President Xi Jinping putting all of these tech leaders like in the forefront of what he's trying to achieve. How much is this to do with the Trump trade tensions, with potentially the rivalry that's just going to heat up in the next few years, and how Beijing needs to position for that? And given that sort of external threat, could you see it being more proactive in terms of helping the private sector?
I think to a certain extent, China needs the private sector to be strong more than ever now. I think, the government is indeed, trying to help the private sector to a certain extent. But having said that, in the past few years, what gets really strong is the SOE sectors, right? So the resources is really going into the SOE sectors, and because of the incentive system, the commercial banks are lending sort of towards the SOE sectors rather than to the private sectors, because if your loan goes sour, you have to be responsible, right? Even if you left the job. Right, so that's the reason why the private sector is not getting enough credit, and if they really want to grow, they have to find a way to get credit from the banking system. Now with DeepSeek, for some reason, you use DeepSeek as an example, right? So the founder is actually a hedge fund tycoon, right? He's loaded, right? So he has money he's willing to burn, and also for his own business, he's been using AI algorithm, to trade, to make money from the Chinese market, and has been very successful. And so I think DeepSeek is one of those sort of accidental sort of fortune that the founder used his own money to burn, and there's a very limited government intervention, and therefore DeepSeek was able to flourish under such system. I think to replicate the success of DeepSeek really needs a really hands-off approach from the government.
I wanted to get your views on Alibaba, because I do wonder, with this sort of return to the fold with Jack Ma, how much could we see a re-reversal of Baba's fortunes, right? Because you can take a look on that chart. 2020 November, when the Ant IPO was called off, we've not even seen, with the recent recovery, that stock price even halfway back to the previous levels. Do you think that this is the start of a meaningful improvement?
Yeah, I think BABA has done a lot of work in the past few years, right? So I think it is actually leading the AI investments in China, right? So a lot of people didn't see the efforts, the endeavors that is being sort of undertaken by BABA. Having said that, though, the stock has rallied for like more than 50% now. All right, so even though it's down substantially from the peak in 2021. People still need to see earnings growth from this company, and also sort of a better sort of a reception from the government for BABA, and also for the entire private enterprise, for people to pick up confidence again in these sectors.
Hao Hong, always great to have you with us. Partner and Chief Economist at Grow Investment Group. Some of the other stories that we're watching around the world. Singapore's Prime Minister Lawrence Wong expected to boost spending in his first budget, offering more handouts to households and businesses ahead of an election. Tuesday's budget is likely to focus on bringing down living costs and increasing social aid. Wong, who's also the Finance Minister, is also expected to detail measures to help businesses focus more on AI. Myanmar's military government says it's ready to hand over about 1,000 foreign nationals rescued from cyber scam centres near the Thai border. The victims are mostly from Asian countries, including China and India, while some others came from East Africa. Myanmar's junta has launched a military operation to combat online scams under pressure from Thailand and China. Bloomberg has learned that Elon Musk's government efficiency team is trying to access a broad range of taxpayer data, including on individuals. The effort has prompted Democratic lawmakers to raise concerns over privacy issues. The US has strict laws that prohibit the disclosure of taxpayer data, with some exceptions for law enforcement. Shery.
Haidi, emergency crews responding to a Delta Airlines crash in Toronto that's injured at least 15 people, 3 of them critically. Bloomberg's Jacob Lorink joins us now from Toronto. Jacob, what do we know so far?
Hey, so far we know that there are about 15 people who've been injured. They were all passengers on this Delta Airlines flight that landed in Toronto around 2:30 p.m. This afternoon. It's incredibly windy and cold in Toronto right now, and it appears that at some point during the landing, this Delta flight flipped upside down and skidded on the runway. It's left about 15 people injured. There are no fatalities. 3 of those injuries are critical but not life-threatening, and those people have been air ambulanced to hospitals around Toronto. So it's a pretty grim scene, though emergency crews they've confirmed that there are no deaths.
Jacob, what do we know about the investigation process?
So the investigation process has started now. Canada's Safety Bureau, they've launched an investigation with assistance from Washington as well. They've sent crews there, and it appears that that's underway. And I believe over the next few days, we'll start to get information around, how this happened, the specifics of what happened, but it's all at the very early stages.
Extraordinary pictures there. Bloomberg's Jacob Lorenk there in Toronto. We have more ahead on the Asia trade. This is Bloomberg. Take a look at one of the stocks we're watching. Qantas at the minute really seeing that decline as the ACCC, the regulator here, proposes to approve the Virgin Australia Qatar Airways alliance. That authorisation would allow the carriers to engage in cooperative conduct under an integrated alliance for 5 years, according to the ACCC. And of course, this has really long been a potential deal that would create quite a lot of competition for Qantas. And of course, this is something that also the government, the Albanese government, has been promising when it comes to the promise of stronger competition, better pricing, better services for people who fly in the aviation sector here in Australia. We've heard from Jane Herdlicker, who's the CEO of Virgin, saying that this is the missing piece of the airline strategy, and we are seeing that downside when it comes to Qantas there. We have really seen that 25% stake from Qatar Airways in Virgin Australia from Bain Capital, and we are seeing the signs that this is going to progress and create really quite a bit of a headache for the dominant player Qantas in terms of diluting what is a very highly concentrated market, and particularly when it comes to the implications to those international routes. Virgin and Qatar planning to use that deal to get more flights into the Gulf, out of the country. That is, of course, a key connection point when it comes to a lot of these lucrative European flights as well. We'll continue to watch Qantas, but one of the other stocks that we're watching in the Aussie session is BHP. This is a picture. We're extending those losses now across what is broadly a risk-off session going into that RBA meeting. But first half profits slumping 23% from a year before. A lot of this was on waning Chinese demand for the likes of iron ore and copper. Let's bring in Bloomberg's Karen Lee for more. So China was obviously a big factor here.
Yeah, and obviously this is a huge stock that we're watching here today. And let's just look at a few of the numbers that have come across the terminal, Heidi. Like you said, first half down 23% since last year. Underlining attributable profit missed estimates. And the interim dividend was cut to 50 cents a share. Now that's the lowest payout for the period since 2017 in 8 years. And that was due to the decreased iron ore and copper demand from China, noting benchmark iron ore and copper prices both fell in the period. At the same time, something we were all tracking here last week, BHP is contending with fallout from tropical cyclone Zelia. That was a Category 5 storm that hit its iron ore mines in Western Australia. And the company said it's maintaining that iron ore forecast output for the Pilbara for the year to June, but it no longer expects production to be in the upper half of the range due to the storm's impact. So coming off of these earnings, that's something people are going to be watching.
They were pretty optimistic, particularly when it comes to copper demand.
Yeah, they were. And despite all of this, there was a decidedly optimistic tone from CEO Mike Henry today. He said demand for BHP products remains strong despite global economic and trade uncertainties. And notably, Heidi, he pointed to early signs of recovery in China and strong growth in India, along with resilient economic performance in the U.S. And they still see copper as a key growth area. There are plans, I'm just looking at my notes here, to spend over $10 billion to maintain and grow production across the Chilean portfolio in the next 15 years. So a lot happening for BHP, and a lot our folks here are keeping track of.
Bloomberg's Karen Lee, and of course we'll continue to break down those numbers and get some views when we speak to the BHP CEO Mike Henry in just a few hours' time. He'll be joining us at 10 a.m. Hong Kong time. That's 11 p.m. if you're watching in Sydney. Let's take a look at some of the other commodities that we're tracking this morning, particularly when it comes to the picture for precious metals as well as oil. We are seeing a little bit of an advance when it comes to New York traded crude, holding on to those gains. OPEC Plus possibly delaying the supply increases. Delegates said that the group is considering that delay of restoration of outputs. We also saw Ukrainian drones attacking a crude pumping station in Russia there as well. So we could see that pushback of a series of monthly supply increases there due to start in April. So watching that, and also watching gold as well, as we've seen really gold prices continue to gain on the mounting anxiety over Trump tariff plans right after the biggest one-day decline in 2 months just a couple of sessions ago. We are seeing gold continuing that ascent. We've seen, 7 consecutive weekly advances for gold. That's the longest winning streak since 2020, Shery.
We're also seeing a winning streak when it comes to European assets, Haidi, all to do with expectations of perhaps more defense spending. Right now, European leaders discussing a potential security package to fund military investment. The estimate right now suggests an additional $3.1 trillion in spending over 10 years. So you can see right there those defense stocks surging on the right of that screen. That's the UBS Defense Index right there against the stock 600, which has already rallied given these defense spending expectations. On the other side, Haidi, though, bonds really pressured expectations of perhaps more common debt issuance. Right, and we continue to watch the geopolitical tensions around, of course, Ukraine and what happens with the talks between the U.S. and Russia. President Trump's top foreign policy officials are in Saudi Arabia for talks with Russian counterparts on Tuesday to push the president's plan to end the war in Ukraine. Meanwhile, a top aide to Ukrainian President Volodymyr Zelenskiy says Kyiv wasn't invited to the talks in Riyadh. Ihor Brusillo, deputy head of Zelenskyy's office, tells Bloomberg it's dangerous to leave Ukraine out of the negotiations.
We can say that now United States is involved deeply in the process and are looking forward. The main thing for President Trump, as was said, to ensure the peace, that it is reliable and stable, so that this war will not recur in any form, in any type, just in 1 year or in 2 years after its completion now.
And I'd like to get your perspective on Trump's approach, engaging directly with Vladimir Putin. I'd like to get an understanding of, obviously, he's setting up this meeting potentially in Saudi Arabia. Will Ukraine be a participant in a high-level meeting in Saudi Arabia with the Russians?
Look, our side and our country was not invited to the meeting, so there will be no representative from what I know as of today at this meeting. And it makes the situation, I would say, dangerous because firstly, and it's obvious, it stands to reason to expect that the talks should be held first with Ukraine to hear our position, to hear what we have to say, and then so the main thing is to avoid these backdoor channels, this back dealing. It doesn't help the situation, and you have to understand the mind of the people who you're meeting with before you can proceed. That's important.
Could you imagine a scenario in which some of these sort of requirements are met and Zelensky could meet with Trump and Putin later this month?
Well, everything is possible now. We live at this speed that is just within our reach sometimes. And if this meeting is to take place, it should be properly arranged. And every party should get the notice well in advance where this meeting is to take place and what is the agenda of this meeting, so that we can move forward on that. So it doesn't work, that you say, well, tomorrow we meet in some place and everyone will go there. It's not a fair approach, I suppose, and I believe that preparatory work is to be done just before everyone gets in.
Ihor Brusillo there, an aide to Ukrainian President Vladimir Zelenskiy, speaking with our colleague Oliver Crook. You can watch us live and catch up on those past interviews using our interactive TV function. That's TV Go. You can dive into any of the securities or the Bloomberg functions we talk about as well, plus join in on the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
Here's the latest from the corporate front. TikTok Shop, the social media platform's e-commerce feature, outperformed competitors in the U.S. in January, including Shein and Temu. Bloomberg's used credit and debit card data to show observed sales for TikTok Shop jumping more than 150% in January, well ahead of its rivals. In particular, TikTok Shop is grabbing more market share at Shein's higher price point of transactions over $25. Southwest Airlines says it will cut more than 1,700 jobs in its leadership ranks, impacting 15% of corporate positions. They're the first layoffs in the carrier's history. The cuts extend the upheaval that's gripped Southwest for much of the past year, which featured a battle with activist Elliott Investment Management, a board overhaul, and significant operational changes. One stock that we'll be watching at the open in South Korea, Samsung, is now going to buy back 2.7 trillion won of shares. This buyback is part of 10 trillion won buyback plans that were announced earlier last year in November. We have seen Samsung Electronics advance in the previous session to the highest level since around mid-January already on expectations of this buyback announcement. Of course, we know that investors have been concerned about Samsung's memory chip business, their vulnerability to trade policy. The shares have taken a hit in the past year. So we've seen Samsung now buy back some of its own shares, Heidi.
Shery, of course, we are inching closer to potentially the first easing move from the RBA here in Australia in about 4 years. So a bit of excitement, but of course also a bit of caution as well, given that we are expecting a relatively hawkish rate cut from the RBA today. That could potentially see Aussie bonds set for a squeeze to higher ground after that meeting. We're seeing 3-year bond futures drifting lower and investors expecting not a whole lot of dovishness from the RBA today. It sets up potentially the risk of a short squeeze higher if the outlook is perhaps quite nuanced when we hear from that press conference. Of course, adding to that, just a broadly uncertain picture when it comes to global trade. The Fed seemed potentially lowering again this year. A pretty supportive picture within for bonds, right, within that US dollar universe as well. If we do see a surprise from the RBA today with a hold, and there are economists that are looking at that as well, we'll see quite a celebration from bond bears. But looking like a pretty lively session either way for Aussie bonds today. Well, the market opens in Seoul and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. After a rally in European stocks, the expectations of a big financial security package really leading to those defense stocks, Heidi, to gain ground. Of course, U.S. markets away on holidays, but the big news today for Asia investors, the RBA rate decision.
That's right. Do we, as consensus is looking like at the moment, get the first easing, the first cut in about 4 years? Or do we get a surprise hold? Consensus is that even with that first cut, the commentary that accompanies it will still be pretty hawkish as well. So we'll see perhaps a bit more of a muted reaction when it comes to Aussie bonds and the dollar as well.
We're watching JGBs here in Japan as well, given, of course, the expectations of potentially more BOJ tightening to come. We had better than expected GDP numbers for the last quarter. That's and the 10-year yield, which was already trading at that 2010 highs to even higher. Of course, we are watching the Nikkei at the moment, not doing much, the topics either, but the Japanese yen in the overnight session gained ground against the U.S. dollar on those expectations of more BOJ tightening. As we continue to watch in the Korean market, you can see also that we're watching Samsung because they've just announced a buyback of 2.7 trillion won of shares. That's part of their $7 billion package that was announced already last year. Expectations of where that AI race goes from here, given, of course, that perhaps Samsung may be lagging behind when it comes to that chip making capability. And we have seen Samsung really take a hit over the past year. So the leadership there buying back its own shares. The Kosdaq at the moment gaining 0.1%, as we're seeing the Korean won holding steady, Heidi.
Take a look at what we're watching when it comes to Australia. Pretty muted session when it comes to equities trading. And of course, we're seeing some sideways trading, but also some negative news flow when it comes to some of the earnings numbers, the likes of BHP. We're also watching Qantas, of course, with that Virgin Qatar tie-up looking like it will proceed according to the green light from the ACCC. Some downside there as well. But broadly, this is also a market that's coming off, repeated record highs that we saw set last week. The Aussie dollar at the moment is really trading sideways, 63.55 is where we're at when it comes to the Aussie. But potentially we could see more gains in store, depending on that signalling from the RBA on how hawkish that policy path will continue to be. This is a picture when it comes to treasuries. We're also seeing Aussie bonds just edging higher ahead of that RBA policy decision. While Bloomberg MLive strategist Mark Cranfield joins us now for more on the action. And so, as I said, consensus seems to be, a cut, but a pretty hawkish one. Where to do you think do we see Aussie bonds as well as the Aussie dollar going, and what are the risks here?
Oh, we're going to have a pretty exciting day for short-term traders in Aussie markets today. There's so much room for trying to pass the language and the direction. So we should have pretty much a whiplash day today in the market. So expectations for a lot of traders is that there will be an easing today, but the outlook will be relatively neutral to hawkish, which means that the next interest, if there's a cut today, the next one after that will still be several months away. That's kind of the consensus expectations that we have. If we get something like that, you could easily see a situation where Aussie dollar drops initially on the headlines and then starts to rebound as traders reassess how much further or how much longer the RBA is going to be before it reduces rates again. Of course, as you mentioned earlier, there is a potential for a surprise. RBA doesn't always follow the script that traders are expecting. They may go on hold with a dovish outlook, in which case you could get the complete reverse. You could get the Aussie bouncing higher and then going lower once people start to see the language and where the outlook is as well. Similar situation for the bond market. If you look at the way that bond futures have been trading, the market's been coming off in recent days and open interest has been rising, which suggests that traders are getting pretty short going into this decision here. So there's definitely room for a short squeeze if the RBA outlook is more neutral than people are expecting. So one way or another, it's going to be a great day for algo trading systems. They tend to feed off these headlines as they come through. It's going to be pretty choppy. Where we end up today really will also be partly determining what's going on in the wider space with treasuries and the US dollar. But if you're a short-term trader, today's your day. RBA is going to give you plenty of excitement.
We're getting a little bit of excitement for Chinese assets as well. The offshore yuan trading around 3-week highs. Is this more justified now that we're seeing President Xi Jinping potentially being more warm towards these private sector leaders like tech?
It's certainly partly related to the improvement in the Chinese markets in recent days. So certainly when you see more money ploughing into Hong Kong shares, especially whether it's the tech shares or the H shares, you can see the very high volumes trading in the equity markets, very good rally across the board there, and to some extent onshore Chinese markets as well. That's obviously a bullish signal for the Chinese currency. It's also being helped by the fact that the US dollar is softer as well. If you look at dollar yen, seems to be leading along with the euro in recent days. And you can see there's a general softening of the US dollar in the G10 space. That obviously feeds through into the yuan as well. But if you think about the volatility that's happening in the Chinese tech sector, especially what we saw yesterday was that the HSI tech gauge was going back and forth between gains and losses several times during the day. It ended the day very slightly lower, but we saw big gains, we saw big losses. It looks as though it's coming towards the point where we need a bit of consolidation in that market. It's been a tremendous rally since the beginning of the year. Very, very high volumes in recent days. A lot of optimism because it looks as though the Chinese leadership now is endorsing the tech sector, which is no wonder considering they're now contributing 15% of growth to the Chinese economy. It's a very, very important part of that. But at the same time, a lot of hot money has piled into that market in recent days. It wouldn't be surprising if we see a little bit of a pullback in the near term. It's looking a bit frothy, and very clearly sentiment is very skewed in one direction. It wouldn't take too much to see a little bit of cooling in that market over coming days.
Do we see some cooling when it comes to, a fairly impressive rebound for the euro, right? There's a lot of risks, though, building, not just tariffs, but the German election outlook as well.
You've got the German elections coming up. You've got France in a bit of a precarious situation. Their government still looks a little bit unstable. But you are seeing some of the European leaders come together to see how they can address the situation in Ukraine. In a way, that's a positive for the euro. People have got used to the idea that Europe can't make major decisions without looking at the United States, looking at other parts of the world. Finally, it looks as though the fact that Donald Trump is willing to go ahead potentially with meeting Russia without any involvement of Ukraine, without the European leaders, it appears to be galvanizing them to get back into a situation where they can make decisions for themselves for the best of Europe. And traders are seeing that. That is a very positive signal. It's something which hasn't been in place for a very long time. Maybe under the days of Angela Merkel when she was leading Germany and Europe, that's what you expected. That hasn't been the case in recent years. So that is something which wasn't really factored into the path of the currency. Also, it means that the European Central Bank probably has to be more slow in lowering interest rates. If Europe is going to foot more of the bill for the rebuilding of Ukraine, that's a big amount of money that was not factored in to the bond markets, into the debt situation in Europe at all. So again, that's a slight positive for the currency. All of those things are gradually being worked out. Nothing has been formally decided yet, but European traders were not expecting this kind of event so early in the year.
Bloomberg M Live strategist Mark Cranfield there. And let's delve into that very high-profile meeting between Chinese President Xi Jinping, featuring many of the country's biggest names in business. Among them was the Alibaba founder Jack Ma, whose presence sends a strong signal that the long marginalized tech sector perhaps is back in the good books. Let's bring in our China correspondent Mingmin Lo in Hong Kong. Mingmin, so who was there and what exactly did President Xi Jinping say?
Yeah, it was a wide-ranging representative from different industries, ranging from robotics to mobile phone companies, EV companies like BYD, CATL, of course, Alibaba's Jack Ma. You have Huawei's Ren Zhengfei, DeepSeek's Liang Wenfeng. Meituan was there as well, the food delivery app. So a pretty wide-ranging representative of businessmen at this symposium. President Xi was there along with Li Qiang, a couple of other high-level officials from the government. And what President Xi said was that we want you private companies to produce more, boost consumption, to innovate. He essentially said this is a prime time for private enterprises to give full play to their capabilities. The private sector enjoys broad prospects and great potential on the new journey in a new era. And he also pledged some specific measures as well. For example, rectifying these unreasonable or random charges, penalties, investigations, seizures of companies, saying that he will protect the legitimate rights and interests of companies. He also said that the government will try to promote fair competition and also make efforts to solve the problem of difficult or expensive financing for private companies.
How much can we read into the fact that Jack Ma was at this meeting as well?
Yeah, I can tell you that this has caused a huge sort of buzz on Chinese social media because Jack Ma is that poster child, one of the highest profile face who had suffered under that multi-year crackdown, the tech crackdown, starting from around 2020 when Jack Ma's huge IPO at that time of Ant, one of his financial company, was abruptly halted because Jack Ma had made some criticisms of Chinese regulators. And that followed several years of crackdown on other companies, including Tencent, Didi as well. And on Chinese social media, people are saying, I'm shocked Jack Ma is back. Others are saying, you know, I see hope now. Jack Ma is back in the public arena. This is a springtime for Chinese private enterprises. So it's really significant that that multi-year crackdown is sort of ending in this very splashy, high-profile meeting where Jack Ma sat in the front row of those business executives. He got a handshake with President Xi, suggesting that maybe this company is now back in safe zone with in its relations with the Chinese government.
Does the détente necessarily mean that we're seeing, you know, that return to support for private enterprises? And is it also selective? Because obviously there were notable absences from the attendees list too.
Yes, it's interesting because quite a number of high-profile companies were not present as well, and that includes Baidu's Robin Li. ByteDance was also not there, along with PDD, JD.com. Some of these e-commerce platforms were not present. So a lot of questions here about how the government actually selected who to attend this, and does this mean that some of these companies are waning in influence or perhaps falling out of favor with the government? That's the question there. And yes, it does signal that the government is softening its stance towards private enterprises with this symposium. But at the same time, it's not likely that they're going to go back to the sort of freewheeling times of the past, where they have an extremely hands-off approach with these private enterprises, because President Xi did make reference to the Common Prosperity Campaign, saying that these companies should get rich first and then spread the wealth to other people. So we will likely still see the government's hand at work, although a more supportive and embracing stance of private enterprises, recognizing their importance in fostering innovation and disruption, especially amid this potential new trade war with the United States.
Bloomberg's China correspondent Mimi Lo there, as we're, of course, headed towards the China market opens. And take a look at what's trading right now. We're watching Samsung, which is now going to buy back a total of 3 trillion won of shares. This is part of that $7 billion buyback that was announced last year. Samsung Electronics has advanced to the highest level since mid-January, and expectations of this happening already. Of course, we have seen investor concerns about its memory chip business, their vulnerability to trade policy, and shares have been down almost 30% or so in the past year. So Samsung now buying back its own shares, Heidi.
Take a look at some of the other stocks that we're watching. When it comes to the automakers, Honda and Nissan is one to watch, two to watch, I should say, as we see Honda sort of had seen that rise on the back of the continued buyback plan. We're also seeing Honda to re-enter talks with Nissan if the Nissan CEO Uchida may leave. That's according to reporting from the FT. Shery.
And still ahead, more on today's Aussie rate decision. Here why Westpac chief economist and former RBA assistant governor Luci Ellis is among the majority expecting a cut. But first, Ukraine is calling on the EU to quickly nominate an envoy for potential peace talks as the US and Russia hold meetings of their own. More coming up. This is Bloomberg.
You have also the European Stability Mechanism, where you have potential funds that could be redirected towards defense. We also need to all continue to step up our effort at the national level. But in the face of this emergency, I think it is time to take historic decisions. And indeed, the question of Eurobonds, for instance, is one of the mechanisms that we should be talking about, I think, in the coming days.
The French Minister for Europe, they're telling us that the joint European bonds are an option to raise funds for defence spending amid tensions with the US over Ukraine. Meanwhile, Ukraine is calling on the EU to quickly nominate an envoy for potential peace negotiations with the US and Russia. It comes as the US Secretary of State and the Russian Foreign Minister prepare to meet for talks in Riyadh without European or Ukrainian officials. Let's bring Bloomberg News editor Michael Heath there, and there's a lot of consternation in terms of these talks, the involvement of Europe and Ukraine, security guarantees, as we heard earlier, as being one sort of prerequisite.
Yeah, I mean, look, there's a lot up in the air. That's exactly right, Heidi. And then even from the Russian side, you know, they're sort of implying that these talks are part of, bringing the US and Russia back, the whole economic side about sanctions, which I'm not sure anybody's really been talking about yet, about any sort of relief there. But we'll have to see what unfolds. But yes, Europe and Ukraine are obviously very, very unhappy that they're not part of this process, that Russia and the US have gone over their heads. And for Russia, that's perfect. It would far prefer dealing just with the Trump administration. Very few of the officials in the Trump administration have negotiated with Russia. Russia's administration is basically comprises former KGB officials. They're fairly serious individuals and who know what they want and drive a fairly hard line. So yeah, look, the interesting part is that Ukraine is sort of saying Europe needs to speak with one voice. It needs an envoy, as you mentioned, and they need to come from leadership level so they can sit at the table with Putin and Trump. And Zelenskiy, obviously, he recently spoke with French President Macron too, who convened a meeting yesterday of European leaders trying to work out this potential financing for European defence and Europe taking on more responsibility. And also putting boots on the ground potentially in Ukraine. So there is a lot up in the air at the moment.
And as you say, boots on the ground, peacekeeping, how all of this is going to be funded as well. There's a lot of concerns across the bloc in terms of how this is going to be handled.
Yeah, I mean, well, on one hand, you have sort of this internal group, of the UK, France, Germany, Denmark, Spain, who have come together and want to get things going. For the smaller nations, they're like, well, the EU is a larger bloc and we all need to be in it. But the difficulty is you get countries like Hungary and Slovakia that have some degree of ties with Russia and are always sort of wanting to go slow on this, that make it very cumbersome and difficult to take decisions. And the speed at which the Trump administration is moving means that Europe it can't afford to go through that process now. It does need to take quick decisions and it needs to speak with one voice. It's always that question, whether you're in Washington or Moscow, if you want to talk to Europe, who do you talk to kind of thing. So yes, they do need to get a lot of things sorted out, but we do seem to be at a pivotal point here in terms of the Europe security, in terms of the architecture of what's going to happen. Things are changing. I mean, just that discussion of a defence bond is really significant, and we saw that in the market reaction. That obviously European defence stocks rallied there. That Europe is going to step up because the US, they just can't be sure that it's going to be there.
Yeah, I mean, this is really lighting a fire under Europe, right? How fast President Trump is now setting up to meet with Russia in Saudi Arabia. So tell us a little bit more about what's the thinking here from Europe, especially as these discussions, as you say, need to happen on perhaps even joint European bonds. There's just such a different array of options for them to try to finance this.
Yeah, that's right. That's right, Shery. One of the options is this European mechanism that they'd used for COVID and when they had their crisis too. They do have funds there that they could deploy reasonably quickly. But the other one is obviously this joint bond. And what's interesting is countries like Denmark that have historically tried to avoid being caught up into these big European spending schemes. They're prepared to be a part of this. They recognise that the goalposts have changed here, and Europe is going to have to spend a lot more on defence and get serious about that, and they are willing to be a part of it. So it looks like things are going to move, and they have to, because Europe's going to find that the US and Russia are negotiating the security structure of the continent without the main nations being involved if they don't move on this quickly. So there is a lot going on, and as you mentioned, we saw European bonds fall because obviously we're talking about more debt being taken on, and then we've seen the defence stocks rally. There were questions: would Europe be buying US arms, as a gesture of goodwill to the Trump administration? The view seems to be that they want to accelerate their own production, and there was even reference to, one of the reasons why Ukraine wasn't able to strike deeper into Russia was because some of the weapons that Europe have US components, which gives the US a say over what Europe can do with it. And that prevented, these long-range strikes until the US agreed to it. There's just so much going on. There's so much interconnectedness there, but it seems like Europe is going to have sort of like a core and an outer group, and that core is going to have to move quickly to keep it engaged in this discussion.
Bloomberg News editor Michael Heath there. We're going to stick with Europe and take a look at how futures are opening amidst all of this geopolitical developments that we're seeing at the moment. We saw defence stocks really lifting broader markets in the previous session on Monday. In fact, stocks in Europe reaching that fresh record high. We might see a bit of profit taking today. Euro Stoxx 50 futures looking a bit flat at the moment. That rally in defence shares really was front and centre after the news of potentially increased security spending and that support for Ukraine there as well. The likes of Metal, Saab, BAE Systems, some of those biggest gainers. We've seen European stocks broadly trading higher this year, over 9% so far this year, and that is an outperformance compared to US peers as well, despite, of course, some of that caution going into the German federal election on February 23rd, some of that caution also being expressed through the euro as well, and some of the risks, despite, of course, what we've seen as a pretty impressive rebound since the new year. Well, Donald Trump's top foreign policy officials are in Saudi Arabia for those talks with Russian counterparts on Tuesday to push the US president's plan to end the war in Ukraine. A top aide to Ukrainian President Volodymyr Zelenskiy says Kyiv wasn't invited to the talks in Riyadh. Ihor Brasilo, who's a deputy head of Zelenskyy's office, telling Bloomberg that it's dangerous to leave Ukraine out of these negotiations.
we can say that now United States is involved deeply in the process and are looking forward. The main thing for President Trump, as was said, to ensure the peace, that it is reliable and stable, so that this war will not recur in any form, in any type, just in 1 year or in 2 years after its completion now.
And I'd like to get your perspective on Trump's approach, engaging directly with Vladimir Putin. I'd like to get an understanding of, obviously, he's setting up this meeting potentially in Saudi Arabia. Will Ukraine be a participant in a high-level meeting in Saudi Arabia with the Russians?
Look, our side and our country was not invited to the meeting, so there will be no representative, from what I know, as of today at this meeting. And it makes the situation, I would say, dangerous because, firstly, and it's obvious, it stands to reason to expect that the talks should be held first with Ukraine to hear our position, to hear what we have to say, and then so the main thing is to avoid these backdoor channels, this back dealing. It doesn't help the situation, and you have to understand the mind of the people who you're meeting with before you can proceed. That's important.
Could you imagine a scenario in which some of these sort of requirements are met and Zelensky could meet with Trump and Putin later this month?
Well, everything is possible now. We live at this speed that is just within our reach sometimes. And if this meeting is to take place, it should be properly arranged. And every party should get the notice well in advance where this meeting is to take place and what is the agenda of this meeting, so that we can move forward on that. So it doesn't work, that you say, well, tomorrow we meet in some place and everyone will go there. It's not a fair approach. I suppose, and I believe that preparatory work is to be done just before everyone's getting.
The Aviation Festival Asia Conference begins in Singapore today, bringing together top global executives in the airline industry. Let's cross over to the event where Bloomberg's Avril Hong is standing by with our first guest. Avril.
Yeah, Shery, business executives the world over are adjusting to U.S. policies and the uncertainty. And I think that's fair to say it's figuring into the conversations even here at the Aviation Festival. I have with me now Richard Nuttall, CEO at SriLankan Airlines. Really good to have you with us.
Good to see you, Avril.
So we are looking at some economic policy uncertainty out of the U.S. Does that in any way shape some of your decision-making in terms of hedging for FX volatility or fuel costs?
So I think for us at the moment, it's really watch and see. We don't have a lot of direct contact with the US economy. Obviously, the biggest single issue will be what it does to fuel prices, but we don't hedge. So really, we're just watching it at the moment. But our traffic flows are mainly within the region. So traffic's not affected. I think the big one will be fuel if anything happens there.
Do you see tariffs having any knock-on impact on travel demand in any way?
I guess not directly short term, but if it starts to have an effect on the global economy over time, then that will start to have an impact.
Richard, we've seen a number of airline safety incidents in recent months. We're seeing another one out of Toronto with a US carrier involved. The FAA has started firings. Is the high airline safety rating being undermined here?
So I think it's too early to say that. I guess if you look at statistics, it's still an incredibly safe way to travel, and it's got safer and safer and safer, and you've got the various authorities working to keep it that way. Every event that goes on, we all learn from. We've also learned not to jump to conclusions, but to wait and see, what the investigations bring up, and then everybody learns from it. So obviously it's very unfortunate for all of those involved, and our hearts go out. But I think it's too early to panic. We just need to keep doing what we have been doing for the last decades and keep learning from everything that happens and get better and better and better.
Okay, talk to us about the company's plans in terms of expansion, in terms of financial health. What are your priorities?
So I think, the airline has been through a sort of turbulent few years. It was well documented that under the previous government, we were looking at privatization. Essentially, after 10 years, the airline has returned to operational profitability. We've been operationally profitable for 3 years. But we still have an awful lot of legacy debt, and we need to find solutions for that before we can go out and do big airline orders or big aircraft orders. In the meantime, we're working to lease aircraft as and when we can. And ideally, our fleet really should be double what it is within 5 years. Now, whether we can get there will depend on financing. The new government doesn't want to privatize the airline or lose control of the airline to foreign entities. Tourism is really, really important to Sri Lanka, and therefore the airline is a national asset that needs to be managed within the company. So there are different options, but they're working through which are the best ones at the moment.
Would strategic investors be on the table?
So I think it's open. It could be, does the government want to continue to own it? Do they want Sri Lankan investors to invest in parts of the business? Do they want to use the stock market? I think that's the ongoing debate at the moment.
Okay, what about the backing you're getting from the government? How secure is that? I mean, Sri Lanka only quite recently exited default. You're government backed. What are the risks here?
Well, so I think, the government is going through an IMF process and is not hugely wealthy. The economy is stabilizing, which is good. But I think the flip side is that the government knows how important the airline is to the economy. They have expressed their commitment. And there's they may not be able to stump up $1 billion tomorrow, but there's a lot of things that you can do working within the infrastructure, working with some of the government-held debt that allows us to keep things going until we can find proper financing. And the support is definitely there. Okay,
you alluded to some of the fleet rejuvenation plans. To what levels and by when are we looking at? And is it mostly short-haul jets that you're exploring?
No, I mean, we're basically half narrow body, half wide body, 320s and 330s. And I think if you look at the mix, as I say, we would like to double in size over 5 years. Whether we can will depend a little bit on financing and probably more on aircraft availability, given the shortages at the moment. But that mix will still be the same. I think, our most profitable routes longer term are the long-haul ones. But that needs the feeder routes, and India and Southeast Asia are incredibly important to Sri Lanka. And when we look now at what we would do with the increased fleet when we get it, a lot of it will be just to increase frequency to existing destinations. The traveller of today, they don't just want to travel on a Monday or a Tuesday or a Friday or a Saturday. They have a time of day they want to travel. And so to stay relevant, it's important that you have enough frequency to have a flight.
Your all Airbus fleet now,
that's correct.
Boeing a viable option in your mind?
So I think the reality is that you always have to look at both options, if nothing else but to keep both manufacturers honest. Clearly, if we're going to go to Boeing, it would have to be a wholesale fleet change. So I think that would be something that might be longer term. So we are going to have to work out what replaces the 330s in due course. And I think that would be the time when you would have a look at Boeing as well as Airbus and what we currently have.
You talked about the importance of the India routes. Does that in some way come at the expense of a return fully to China?
No, I don't think so. I mean, we fly to Guangzhou. We looked to go back to Beijing and Shanghai a couple of years ago, but the market wasn't really ready. We will go back to both of those markets. It's a little bit driven by fleet availability at the moment. So we see them as two different markets. But India is right next door. It's 1.5 billion people on our doorstep. It's the biggest source of tourism. We are a natural connecting point for Indians, particularly going south and east. And so it's our single biggest market outside of Sri Lanka.
India, a priority.
Yeah.
Richard, really good to chat with you. Thanks so much for taking the time to pop by.
Thanks very much, Avril.
Thank you. Sri Lankan Airlines CEO Richard Nuttall with me here. Shery?
Yeah, and Avril Hong, of course, there in Singapore with much more ahead from the Aviation Festival. We'll unpack the outlook for corporate travel with the World Travel and Tourism Council CEO, Cebu's Pacific's chief, telling us how they are addressing supply chain and engine challenges. We also talked to business strategy with the boss of Indian low-cost airline SpiceJet. Take a look at how we're setting up early in the trading session across Asia. We're watching the Kospi at the moment, recouping some of those earlier losses. Samsung is one of those names to watch as they're buying back a total of 3 trillion won of shares as part of their $7 billion buyback that they announced last year. The Nikkei not doing much. We have, of course, been watching the Japanese yen. In fact, the 5-year JGB yield at the highest level since October of 2008. We continue to get strong, solid economic data out of Japan, really leading to speculation that the BOJ will continue to tighten. The big one, of course, is the RBA rate decision today. The expectation for a cut to interest rates for the first time in 4 years. The ASX 200 being led lower by energy, financials, and real estate stocks, as the Aussie is under a little bit of pressure, but still at around that 2-month high ahead of the RBA rate decision. Now, a couple of companies that we're watching today in the auto sector in Japan. We are now seeing media reports that Honda is willing to resume takeover talks if Nissan's chief executive Makoto Uchida steps down. Do we have the potential for the world's 4th biggest car producer to actually be created if these merger talks continue? We'll be watching the reports around these companies, Heidi.
And Shery, take a look at some of the other stocks that we're seeing across Australia at the moment that are movers. We're actually seeing a bit of a sort of turnaround when it comes to BHP Group. Despite that first half profit falling 23%, they had been trading largely sideways as a lot of those numbers were in line, despite being still disappointing when it comes to the downside in demand for iron ore and copper out of China. They were fairly optimistic about the key growth area for copper going forward, as well as the impact of the tropical cyclone in WA as well, but still a lot more money being spent to grow the copper production assets in the Chilean portfolio. So we're seeing BHP staging a turnaround. Not a turnaround, though, when it comes to Qantas Airways. We're seeing downside of about 0.8%, with the ACCC, the regulator here, proposing to approve that Virgin Qatar Airways alliance over the integrated alliance for a period of 5 years. And that, of course, will be a serious aspect of competition for Qantas, particularly when it comes to those lucrative European routes that go through some of the hubs that Qatar also operates in as well. When it comes to BHP, we'll get more on those numbers, the outlook with the CEO, Mike Henry. He'll be joining us at 10 a.m. Hong Kong time. That's 1 p.m. I should say, if you're watching here in Sydney. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching, particularly a big day for the RBA, right? Potentially, as is consensus, we'll see that first rate cut in 4 years. Take a look at the picture when it comes to the Aussie CPI falling within that RBA 2 to 3% target. Let's bring in Luci Ellis, who's the chief economist at Westpac. She was, of course, previously also an RBA assistant governor. Luci, really great to have you on what could be a momentous day. Of course, there's quite a bit of caution as well. When it comes to the CPI basket, is there too much kind of scrutiny over the variation in the components that we're seeing?
I think what we're seeing is a genuine ratchet down in inflation, just as everybody expected, and in fact a little bit faster than what the RBA had been predicting. I mean, the trimmed mean measure, which is the one that the RBA focuses on in its forecasting models and as the best single indicator of the underlying momentum in inflation, well, that's actually stepped down faster than they expected, and over the second half of last year was running at an annual rate of 2.7%. So that's well and truly in their band. And based on what we're seeing in some of those components, it's likely to stay there.
There's a lot of uncertainty, both in terms of the geopolitical front, global trade, the messiness of what tariffs and counter-tariffs could do from the US and across the region, and also the domestic strength that we see in things like consumer spending as well. Does that give the RBA good reason to balance that with the hawkish cut today?
Well, I think they will be cautious. I don't think they will be telegraphing, a rapid succession of cuts. I do think they'll be cautious. I think they'll be data dependent.
So a shallow cycle is what you're expecting?
Yes, that's what we're predicting, is a relatively shallow cycle compared with history. And we're not predicting that they'll back up a cut today with a cut in their April meeting. But you've got to remember, yes, things are very uncertain, But if you're not sure where the ball's going to land in the court, you don't stay at one side, at one edge of the court. You want to be in the middle, or you certainly don't want to be at your most extreme policy setting. You want to be, nimble and able to respond. Now, I think a lot of people are saying, well, it would be a terrible thing if they cut rates and then had to raise rates again. Well, if something else comes along, some other shock, then of course you respond. But the reality is what we're seeing in the Australian economy does not point to a resurgence in inflation. There's not a lot of additional inflation pressure coming from the domestic economy. Wages growth is another area that has undershot what the RBA was expecting, and we'll see more of that tomorrow. This is not a situation the same as the US. Yes, the Trump administration is imposing tariffs on the US. That raises prices in the US. It doesn't really do anything to inflation here.
Given the concerns over tariffs, we have seen the Aussie dollar really pressured. Are we going to see less risk for more downside on the currency if we do, in fact, see a shallow easing cycle?
Well, we are expecting the Aussie dollar to stay at that low end of the range over the next little while, even though the US dollar is overvalued. I think, the tension we see in the FX market is, yes, at the moment, there has been a period where the Aussie dollar has been quite weak against the US dollar, as have most other currencies. That's a US dollar story. What we're seeing, though, is those forces are bringing the US dollar to be more overvalued on a real effective basis than at any time since the 1980s Plaza Accord. So, in a 3 to 5 year horizon, it'll be a very different story.
What's that meant for businesses on the ground and, of course, a rate environment as well?
Well, I think there's been a real disconnect between how our households are feeling about the current situation, how businesses are. And you see that in the various sentiment surveys. Business sentiment has actually held up better than consumer sentiment, which has really been in the doldrums for a number of years, although it has picked up in the last couple of months to a still below average level. The reality is Australian businesses were, they saw their costs increase, but they were able to raise their prices and pass a lot of those cost increases on. Similarly, they were selling into the whole Australian economy, whereas Australian households really only see the per capita economy. And one of the big forces, one of the big ripple effects from the pandemic was that surge and catch up in population growth, which is now rolling over, but which meant that the customer base for businesses was expanding, but that wasn't something that was being felt as a positive by individual households.
Do you think a cut today, with the expectation that it's going to be quite an uneven cycle, even if the easing continues, does it help with the sort of animal spirit side of the cost of living crisis?
Oh, I think it absolutely will help with people's sentiment. I think it's something that a lot of people are hanging out for, and I basically can't go out without someone accosting me and saying, I hope you're right about rates declining. People are really hanging out for this rate cut, particularly in the household sector and the consumer-facing part of the business sector. They're really feeling it. Of course, it's not just interest rates that's been doing that. It has been that cost of living, the high level of rent, the high level of prices, and the incredible increase in the tax take that we have seen, up until the stage 3 tax cuts. And of course, bracket creep started again on the 2nd of July. So the tax take on households has been rising in a trend sense and is still historically very high. And that really has made a difference to how people are feeling, in addition to the interest rate effect.
I wanted to get your views on dwelling prices. Obviously, it's almost a national obsession for Australia. We did hear the announcement about foreign buyers being banned for 2 years, generally not being seen as being a very effectual policy. What do you think is the answer when it comes to housing affordability?
Well, the reality is that we were always going to have a problem when you suddenly surged the population growth rate to 2.5%. Even if we had the world's most flexible construction industry, which we do not, you wouldn't suddenly be able to pivot to build 30 to 40% more houses in a year than you otherwise were. We have 220,000 unbuilt homes as at sort of late last year. So there's a huge backlog that's just not getting completed that would make a difference, where we've been running through a huge supply shock on the construction industry. So it was inevitable that you would see both rents and house prices have that second wind since 2020, late 2022, early 2023. But that is coming off. Sydney prices are falling. Melbourne prices have been falling for a while. The other smaller cities, they're not falling, but they've certainly slowed in terms of their growth rate. National, the last couple of months, the national average house price has actually been falling, which is what you'd expect. So yes, maybe with slightly lower interest rates, you will see, a bit of a pickup again. But we're not expecting people to, really pile into this market at these prices, because it is already stretching their affordability even at lower interest rates.
In terms of the global factors, have we seen a sort of a positive, a decorrelation when it comes to when China sneezes, Australia does very poorly argument?
It's interesting because people used to think that when the US sneezed, everybody else caught a cold. We are much more connected to China. But importantly, we're connected to their domestic demand as much as to their export industry. We're connected to their steel demand. If you look at Australia's exports to China, they're utterly dominated by iron ore. And while China has reached peak steel, they're not going to be producing more steel going forward than they did in, say, 2019. It's pretty much topped out. It's also not falling. And so for the time being, these are really important export markets, and that's a very important connection that we have.
Luci, very popular time to be an economist, so we thank you for letting us accost you on RBA Decision Day. Luci Ellis is the Chief Economist at Westpac and, of course, formerly of the RBA. Subscribers can also get more on the Bloomberg when it comes to that imminent decision from the RBA. That's TLRV Go. You can get commentary and analysis from our expert team of editors who are poised live to react there. We have much more on Australia Ahead every Tuesday at 11:40 a.m. if you're watching here in Sydney. That's 8:40 a.m. if you're in Hong Kong. You can also tune in to our Bloomberg Australia podcast, delving into the biggest stories shaping the country's role in global business. That's on Apple, Spotify, or on Bloomberg.com. More ahead here in the Asia Trade. This is Bloomberg.
China's stock bulls will be hoping for a boost today after President Xi Jinping's meeting with some of the biggest power players in the country's private sector. For more, let's bring in the China Show co-anchor, David Inglis. David, who cares about Chinese equities rally? We're finally in the same studio. This is why I wanted you in the show.
I was actually a bit of inside baseball for our viewers right now, and we're live, right? Yeah. So I was actually just telling Shery right now. Actually, Rebecca's here too, and she can join the party in a moment. I was just telling Shery that last time we were in the studio together was, I think, before you left for New York, and I actually sent you that picture. It was right at about there. We had a desk back then, and the reason I think that's relevant right now is we talk about how far are we from levels back then of this Chinese equity market. Yes,
oh my God, you brought it back to Chinese equities markets. I was like, how is he going to bring it back?
Well, and so here's the thing. Your question, right, can the rally is set to continue?
I did not ask you a question, David. I was just happy to see you. But yes, if you want to go there, please.
No, so what are we getting for lunch today, actually? So, I mean, okay, let me just answer the question very quickly. Futures are pointing higher. There is some momentum coming through. But we're at a point where valuations have reset. Momentum seems to be on the slightly hotter side of things, and we have earnings coming out of Baidu today.
Right.
So we'll really know how investors really feel after the initial reset of things. But yeah, what are we having for lunch today?
We haven't decided yet, but if you have any recommendations, send it our way. Do you think this feels different, the momentum that we're seeing in China? We've seen so many cycles before, right?
Right. Interesting you brought out. So right before I came on set, I actually had a look at the initial leg higher back in October. We were above the 70 level on RSI for about 15, 16 days. We're going on 16 days right now. So we'll see. Does it feel different? It certainly feels different from the perspective of the audience that are asking about exposure to China is not so much domestic, but foreign investors have again turned their attention back. And that's the incremental buyer you need.
Yeah, let's see if this is actually just FOMO or it can actually be sustained because of fundamentals. But So good to see you, David Inglis. That's it from the Asia trade. But of course, David Inglis stays. The China show is next as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. This is Bloomberg.